Welcome to this deep dive. Today, we're cracking open the Radcom Q2 2025 earnings call from August 13th. Our goal here is pretty simple. Cut through the noise, the metrics and the jargon, and really pull out the key insights for you on their performance, especially around Agentic AI and 5G.
Yeah, and the market definitely noticed something. The stock ticked up, about 2.7% right after the release on pretty heavy volume, too, like 3 times normal. So that suggests the street saw something solid there, maybe more than just meeting the numbers, like real strategic momentum.
Okay, let's dig into that financial momentum then, because, the results look pretty sharp. It feels like disciplined execution. Let's start at the top. Revenue.
Revenue set a record, $17.7 million. That's 19.3% growth year over year, nicely ahead of what analysts were expecting. And profitability, same story. Non-GAAP EPS came in at 25 cents. The street was looking for something closer to, $3.22? So a solid beat there, too.
And the thing that really jumps out, or at least it did to me, is the operational leverage. They're growing, sure, but they're getting more efficient doing it. That non-GAAP operating margin hit 19.5%. I mean, that's a jump of over 400 basis points year over year. That shows the software model is scaling, right?
Absolutely. It really speaks to the scalability of their platform. But, what makes the whole financial picture look so secure is the balance sheet. They generated $2.6 million in free cash flow just in the quarter, and they finished Q2 with, get this, $101.6 million in cash and short-term deposits, zero debt.
Wow. Okay. $101.6 million. That's a serious war chest for a company this size. Before we get into what they might do with all that cash, let's just quickly touch on a couple of other details. GAAP operating income, $1.7 million, about a 10% margin, and non-GAAP gross margins still looking strong at 76.2%.
And if you look under the hood a bit, you see the R&D spend was up almost 11% year over year, about $4.5 million. That's them investing strategically, right? Funding that innovation in Agentic AI and those partnerships we need to talk about.
Okay, but I have to ask about something that came up in the Q&A, the currency exposure. They said 60% of their operating costs are in Israeli shekels, but they don't hedge it. I mean, with the dollar weakening against the shekel lately, isn't that kind of a risk? Or do they just see it as manageable?
That's a fair question. Look, it seems like their philosophy, or maybe just their confidence right now, is that strong execution and the margin improvements can absorb those FX swings. You're right. The weaker dollar does technically increase their costs in dollar terms. So far, they seem okay with it. But if the dollar keeps sliding, that lack of hedging, it could become more of a headwind down the line. Something to watch.
Got it. Okay, so looking ahead then. Guidance for the full year 2025, they held firm.
Yep, reaffirmed, targeting revenue growth of plus 15% to 18%. So the midpoint works out to around $71.1 million for the full year. Message seems to be steady as she goes.
Steady, yeah, but then there's that $101.6 million question, right? The cash, what are they planning?
Exactly, that was the big topic. And the leadership, CEO and CFO, were pretty clear. They said potential M&A is the, quote, first priority. They even mentioned they're already progressing with a few potential candidates. So that cash isn't just collecting dust. Sounds like it's earmarked for a potential deal.
Right. That makes things very interesting. They also shed some light on the growth pipeline, didn't they, over the next 18 months?
They did, expecting about 2/3 of the growth to come from expanding deals with current customers. The land and expand model, sticky revenue. And the other third, from winning new logos, new customers.
And that mix feels pretty healthy, right? Expanding with existing customers is usually higher margin, lower risk.
Definitely. Plus, they confirmed they're in the mix for multiple big RFPs globally. Decisions expected later this year. So the pipeline seems active and focused on those larger tier 1 operators.
Okay, so let's shift gears a bit. We've got the strong financials, the cash pile, the pipeline. Let's talk strategy. How does this quarter validate their bigger tech bets?
Well, it really comes down to the convergence of, 5G buildouts and this huge wave of AI. Their whole focus is on intelligent, automated, real-time network assurance. And look, that big multi-year 8-figure renewal they announced just before the call, the North American one, that's huge validation. It shows their stuff works at massive scale for the big tier 1s.
And their core tech angle is this agentic AI. Can you unpack that a little? It's not just standard machine learning, is it?
No, not at all. Think of it as moving beyond just finding problems. Agentic AI is about AI agents that can autonomously, see an issue, figure out the cause, and then actually trigger the fix or optimization without a human needing to step in. They even quoted some Accenture data, saying something like 84% of telco execs expect this kind of AI to fundamentally change how they operate. That's why Radcom is so focused on it and using things like accelerated computing to handle the crazy complexity and data volumes of 5G.
Which leads us right into the partnerships. First one, Nvidia. Using their Bluefield-3 DPU. Why is that specific piece of hardware, the DPU, so important here?
Right. So traditional CPUs, they just get choked by the amount of data flowing through 5G networks. A DPU, like the Bluefield-3, is specialized hardware. It's designed to handle moving data, security, processing, all really efficiently, right at the network edge. Radcom's using it for a high-capacity user analytics solution. The promise is much faster, lower latency visibility into what's happening right where it's happening. It could be a real game changer for real-time analysis.
Oh, okay, that makes sense. And they said customers are already kicking the tires, moving from just talking about it to actual lab deployment.
Exactly. They're targeting a commercial launch for early 2026. So yeah, this isn't just slideware. It's moving towards reality.
And the second big partnership is with ServiceNow. How does that fit in?
That's about connecting the dots beyond just the network team. Integrating their ACE platform, their assurance tool, with ITSM systems like ServiceNow, well, it tightens the whole feedback loop.
What does that mean in practice, though? Why does connecting assurance to IT service management matter to an operator?
Because it proves the value. When their agentic AI automatically fixes something or prevents an outage, that action and its impact get tracked in ServiceNow, which handles all the support tickets, workflows, customer experience stuff. It lets the operator actually quantify the savings from AI ops. It translates better network performance into actual dollars saved, which makes justifying the investment much easier.
Okay, yeah, that closes the loop. And they highlighted some big names using their tech already. AT&T, DI Initiatives, Boost Mobile, Rakuten in Japan. These aren't small test cases.
No, these are major tier ones with complex cutting-edge networks. Seeing adoption there across different types of deployments like cloud native and traditional, that's strong validation.
And the backdrop seems favorable too, right? Operators are spending on automation, on analytics, trying to improve customer experience and cut costs.
Definitely. The industry tailwinds are there, which makes their competitive positioning really interesting. Management actually pointed out that some competitors are trying to leave the telco space.
Yeah, I caught that too. Why would competitors back away while Radcom is, as they put it, doubling down on telco?
It's a tough market. Telco assurance is incredibly complex and needs deep expertise, specialized tech for 5G scale and real-time needs. Some bigger, more general players might see easier wins in the broader enterprise IT space. Radcom seems to be leaning into that complexity, focusing specifically on things like lowering total cost of ownership for telcos and helping them on their specific AI journey. That AI-driven observability niche, it's still pretty underpenetrated. That's their playground.
Okay, so we've got the cash, the strategy, the market position. If you're watching Radcom over the next year, year and a half, what are the key things, the catalysts to look out for?
Okay, number one, confirmation those Bluefield-3 pilots turn into actual paying contracts. That's crucial. Number two, more integrations, like the ServiceNow one. Can they build more bridges to enterprise systems? Three, got to watch that non-GAAP margin. Can they keep it hovering around that 20% mark consistently? And finally, number four, news of landing one or more of those big tier one deals from the current RFPs. That would give real confidence in the backlog and future growth.
Right. And we should probably mention the new CEO, Benny Epstein, who came on board late last year. Seems like he's really driving this focus on global sales and partnerships using his background with tier ones.
Yeah, that leadership context is important too.
All right. Now for our favorite segment. Time to pitch an outrageous, but maybe just maybe, plausible idea based on everything we've just unpacked. And let me stress, this is purely speculative, definitely not financial advice.
Okay, here goes. The whole idea hinges on that massive cash pile, the $101.6 million highest ever for them, and management explicitly saying M&A is priority one. For a company their size, that much cash means they could do something genuinely transformative, not just a small tuck-in.
So what's the outrageous but plausible trade?
Well, you could consider shorting one of those competitors that management says is trying to shift out of telcos. Take those proceeds and go long Radcom. The bet is that Radcom pulls the trigger on a significant, non-dilutive acquisition maybe later this year or early next, using that cash. They could instantly buy their way into a new market or a new tech domain.
Like what kind of domain?
Maybe something like satellite direct-to-device analytics. They hinted there was an active opportunity there, but maybe hesitated on allocating capital internally. An acquisition could leapfrog them right into it. The payoff, this kind of M&A-driven scale could instantly elevate them, take away that smaller player tag they sometimes get next to the giants. It could make them a dominant specialized force much faster.
Interesting. A bet on strategic, cash-fueled acceleration.
Exactly. The market liked the clean Q2 beat and the strategic direction. A bold, successful M&A move feels like the logical next step for a debt-free, high-margin company looking to really scale up.
Okay, so let's quickly recap the core takeaways from this deep dive. Radcom delivered strong Q2 results, they reaffirmed their growth outlook, and importantly, they provided validation for their agentic AI and 5G strategy through key partnerships like Nvidia and ServiceNow, plus that big North American renewal.
Right, and the big picture here is that this convergence of 5G and AI is forcing telcos to change how they operate. They have to automate. So the really fascinating race to watch now is how fast can Radcom turn things like that Bluefield-3 lab trial into major revenue-generating commercial wins? Can they do it before the bigger, maybe slower-moving assurance players fully catch up and embrace this kind of agentic architecture? That's the key question.
A race for scale indeed. Well, that's all the time we have for this deep dive. Thanks for joining us.